Hey there, everyone! Welcome back to our channel. If you're new here, my name is Your Name, and today we're diving into a topic that's crucial for anyone interested in investing. What is a diversified portfolio? Whether you're starting your investment journey or you're a seasoned pro, understanding diversification can make a significant difference in your financial well-being. So, let's get started. But first, let me ask you a question. Have you ever heard the saying, "Don't put all your eggs in one basket"? Well, that's the essence of diversification. So, why is it important to spread your investments across different asset classes? Alright, let's break it down. A diversified portfolio is an investment strategy that involves spreading your investments across various asset classes, industries, and geographical regions to reduce risk. The main goal here is to minimize the impact of a poor-performing investment on your overall portfolio. Imagine you own shares in a technology company, a couple of bonds, and a piece of real estate. If the tech sector experiences a downturn, you still have your bonds and real estate to buffer your losses. Let's look at the stock market as a prime example. If you invest solely in a single stock, say, a popular electronics manufacturer, you might see incredible gains if the company performs well. But what if they face a scandal or a major product failure? Your investment could plummet overnight. However, if you diversify your stock investments among different sectors, like technology, healthcare, and consumer goods, you reduce the risk of losing everything to one market event. According to a study by Vanguard, a well-diversified portfolio can reduce risk without sacrificing returns. Now, let's consider bonds. Bonds are often viewed as a safer investment compared to stocks. By including bonds in your portfolio, you can balance the volatility of the stock market. For instance, when stocks are performing poorly, bonds often hold their value or even appreciate, providing a cushion for your overall investment. And then there's real estate. Investing in real estate can provide rental income as well as potential appreciation in value over time. By including real estate in your diversified portfolio, you gain exposure to another asset class that doesn't always correlate with the stock market. But diversification doesn't just stop at different asset classes. You can also diversify geographically. For instance, investing in international markets can expose you to growth opportunities in emerging economies. If the US market is stagnant, perhaps the Asian or European markets are flourishing, balancing your overall risk. Research shows that a diversified portfolio can potentially lead to higher long-term returns. According to a recent report by Morningstar, portfolios with a mix of asset classes had 40% lower volatility compared to portfolios concentrated in one asset class over a 30-year period. That's a significant difference. So, how do you create a diversified portfolio? Here are a few practical steps. 1. Assess your risk tolerance. Understand how much risk you're willing to take. Younger investors might be more inclined to take risks since they have time to recover from losses, while those nearing retirement may prefer a safer approach. 2. Choose a mix of assets. A common suggestion is to have a blend of stocks, bonds, and alternative investments like real estate or commodities. A typical recommendation might be a 60-40 split of stocks and bonds, but this can vary based on individual goals. 3. Invest in index funds or ETFs. These funds can offer instant diversification since they track a broad index, like the S&P 500. By investing in an index fund, you gain exposure to hundreds or even thousands of stocks in one go. 4. Rebalance your portfolio. Over time, some investments will grow faster than others, which can throw your desired asset allocation off balance. Regularly rebalancing your portfolio ensures you maintain your target allocation and risk level. 5. Stay informed. The investment landscape changes constantly. Keep an eye on market trends and economic indicators that can affect your investments. In summary, a diversified portfolio is all about spreading your investments across various asset classes, sectors, and geographical regions. This strategy can reduce risk and enhance potential returns over the long term. Remember, while no investment is without risk, diversification can help you manage that risk effectively. If you found this video helpful, please give us a thumbs up, subscribe to our channel, and share it with your friends who might also benefit from learning about diversification. And let us know in the comments, what do you include in your diversified portfolio? Thanks for watching, and we'll see you in the next video where we'll explore more tips on how to secure your financial future. Happy investing!